Chapter 3 Applicability of Accounting Standard Learning Outcomes. After studying this chapter, you will be able to comprehend the status of accounting standards, understand the applicability of accounting standards. Chapter Overview. Status of accounting standard. Applicability of accounting standard for corporate entities. Applicability of accounting standard for non-corporate entities. Status of accounting standards. It has been mentioned in this chapter that the standards are developed by the Accounting Standard Board of Institute of Chartered Accountants of India and issued under the authority of its council, which are approved by the MCA, Ministry of Corporate Affairs. For corporate entities, the standard cannot override laws and local regulations. Accounting standards are nevertheless made mandatory from the date notified by the MCA and are generally applicable to all enterprises subject to certain exceptions as stated below. The implication of mandatory status of accounting standards depend on whether the statute governing the enterprises concerned required compliance with the standard. Example: the Ministry of Corporate Affairs have notified accounting standard for companies incorporated under Companies Act 1956 or Companies Act 2013. In assessing whether an accounting standard is applicable, one must find correct answer to the following three questions. Does it apply to the enterprises concerned? If yes, the next question is, does it apply to the financial statement concerned? If yes, the next question is, does it apply to the financial concerned? The preface to Statement of Accounting Standards answer the questions. Enterprises to which accounting standard apply. Accounting standard apply in respect of any enterprises, whether organized in corporate, cooperative or other forms, engaged in commercial, industrial or business activities, whether or not profit oriented, and even if established for charitable or religious purpose. Accounting standards, however, do not apply to the enterprises solely carrying on the activities which are not commercial, industrial or business activities or business nature. Example: an activity of collecting donation and giving them to flood affected people. Exclusion of enterprises from applicability of accounting standard would be permissible only if no part of activity of such enterprises is commercial, industrial or business in nature. Even if a small proportion of activities of enterprises were considered to be commercial, industrial or business in nature, The accounting standard would apply to all activities, including those which are not commercial, industrial, or business in nature. Implication of mandatory status. Whether the status governing the enterprise does not require compliance with the accounting standard. Example, a proprietor partnership form. The mandatory status of an accounting standards implies that in discharging their attached function, the member of the institute are required to examine whether the financial statements are prepared in compliance with the applicable accounting standard. In the event of any deviation from accounting standard, they have the duty to make adequate disclosure in their report so that the user of financial statement may be aware of such deviations. It should nevertheless be noted that responsibility for the preparation of financial statement and for making adequate disclosure is that of management of the enterprise. The auditor's responsibility is to form his opinion on report on such financial statements. Section 129(1) of Companies Act 2013 require companies to present their financial statement in accordance with the accounting standard notified under Section 133. Section 123 of Companies Act 2013. Refer note below. Also, the auditor is required by Section 143(3)(e) to the report whether, in his opinion, the financial statement of the company audited comply with the accounting standard referred to in Section 133 of Companies Act 2013. Whether the financial statement of a company do not comply with the accounting standard, the company should disclose in its financial statement the deviation from accounting standards, the reason for such deviation, and the financial effect, if any, arising out of such deviation as per Section 129(5) of Companies Act 2013. Provide also that the financial statement should not treated as not disclosing a true and fair view of state of the affairs of the company merely by reason of fact that they do not disclose. In the case of insurance company, any matter which are required to disclose by the Insurance Act 1938. In case of insurance company, any matter which are not required to be disclosed by the Insurance Act 1938 or the Insurance Regulatory and Development Authority Act 1999. In case of a banking company, any matter which are required to disclose by Banking Regulation Act 1949. In the case of company engaged in generation or supply of electricity, any matter which are not required to be disclosed by Electricity Act 2003. In the case of company governed by any other law for the time being in force, any matter which are not required to be disclosed by the law Note: as per Companies Act 2013, the central government may prescribe standard of accounting or addendum thereto as recommended by the Institute of Chartered Accountants of India in consultation with National Financial Reporting Authority (NFRA). Financial item to which accounting standard applies. Accounting standards are intended to apply only to items which are material. An item is considered material if its omission or misstatement is likely to affect economic decision of user. Materiality is not necessarily a function of size. It is the information content that is the financial item which is important. Penalty of 50,000 paid for breach of law by company can be seems to be relatively small amount for the company incurring crore of rupees in a year. Yet it is material item because of information it's convey. Materiality should be therefore be judged on the case to case basis. If an item is material, it should be shown separately instead of clubbing with the other item. For example, it is not appropriate to club the penalties paid with the legal charges. Accounting Standard and Income Tax Act 1961. Accounting standard intend to reduce diversity in application of accounting principles. They improve comparability of financial statement and promote transparency and fairness in their presentation. Reduction and exemptions allowed in computation of taxable income on other hand is matter of fiscal policy of government. Thus an expense required to be statement of profit loss by an accounting standard. Thus an expense is required to be taken statement of profit and loss by an accounting standard does not imply that the same is always deductible for income tax purpose. For example, depreciation on assets taken on financial lease is charged in the books of leases as per AS 19, but the depreciation for income tax purpose is allowed to lessor, being the legal owner of assets rather than to the lessee. Likewise, recognition of revenue in financial statement cannot be avoided simply because it exempted under section 10 of Income Tax Act 1961. Income computation and disclosure standard. Section 152 145 subsection 2 of Income Tax Act 1961 empowers the central government to notify in official gazette from the time to time in income computation and disclosure standard to followed by any class of SSC or in respect of any con- class of income. According to central government, accordingly, the central government has in exercise of the powers conferred under Section 145 of Income Tax Act 1961 notified 10 income computation of disclosure standard to be followed by all SSC other than individual or Hindu undivided family who is not required to get his account for previous year audited in accordance with provision of section 44AB of Income Tax Act 1961 following the mercantile system of accounting for the purpose of computation of income chargeable to income tax under the head profit and gain of business or profession or income from other sources for the assessment year 2017-18. The 10 notified ICDS are ICDS 1. ICDS stands for Income Computation and Disclosure Standards. ICDS 1 Accounting Policies, ICDS 2 Valuation of Inventories, ICDS 3 Construction of Contracts, ICDS 4 Revenue Recognition, ICDS 5 Tangible Fixed Assets, ICDS 6 Effect of Changes in Foreign Exchange Rate, ICDS 7 Government Grants, ICDS 8 Securities, ICDS 9 Borrowing Cost, ICDS 10 Provision of Contingent Liabilities and Contingent Assets. Applicability of accounting standards. For the purpose of compliance of accounting standards, the ICAI has issued an announcement on criteria for classification of entities and applicability of accounting standard. As per announcement, entities are classified into 4 levels. Level 4, Level 3 and Level 2 entities as per the said announcement were referred to micro, small and medium enterprises. However, when accounting standards were notified by central government in consultation with the National Advisory Committee on Accounting Standards, the central government also issued the criteria for classification of entities and applicability of accounting standard for the companies. According to the criteria for classification of entities and applicability of accounting standard as issued by government, there are 2 levels, namely small and medium sized companies SMCs as defined in Companies Accounting Standard Rule 2021, and companies other than SMCs. Non-SMCs are required to comply with all accounting standards in their entity entirely, while certain exemption relaxation has been given to SMCs. Criteria for classification of entities and applicability of accounting standard for corporate entities and non-corporate entities has been explained in the coming paragraph. Criteria for classification of non-companies for applicability of accounting standard. The Council of ICAI at 400th meeting held on March 18-19 2021 considered the matter relating to applicability of accounting standard issued by the ICAI to non-companies enterprises. The scheme for applicability of the Companies Act 1956 is being replaced by Companies Act 2013 in a phased manner now as per Section 133 of the Companies Act 2013. The central government may prescribe the standard of accounting or any addendum thereto as recommended by the Institute of Chartered Accountants of India, constituted under Section 3 of Chartered Accountant Act 1949, in consultation with and after examination of recommendations made by the National Financial Reporting Authority. Section 132 of Companies Act 2013 deal with the constitution of NFRA. The scheme for applicability of accounting standard to non-company entities shall come into effect in respect of accounting period commencing on or after 1st April 2020. For the purpose of applicability of accounting standard, non-company entities are classified into four categories: level 1, level 2, level 3 and level 4. Level 1 entities are large size entities. Level 2 entities are medium size entities. Level 3 entities are small size entities, and level 4 entities are micro entities. Level 4, level 3, level 2 entities are referred to as micro, small and medium size entities, MSME. The criteria for classification of non-company entities into different levels are given in the Annexure 1. The term small and medium enterprises, SME and SME, used in accounting standards shall be read as micro, small and medium size entities and MSME respectively. Level 1 entities are required to comply in full with all accounting standards. Certain exemption relaxation has been provided to level 2, level 3 and level 4 non-company entities. Applicability of accounting standard and exemption relaxation to such entities are given in Annexure 2. This announcement supersedes the earlier announcement of the ICICI on harmonization of various differences between accounting standard issued by the ICAI and accounting standard notified by the central government, issued in February 2008. To the extent it prescribes the criteria for classification of non-company entities, non-corporate entities, and applicability of accounting standards to non-company entities, and the announcement revision in criteria for classifying level 2 non-corporate entities, issued in January 2013. The announcement is not relevant for non-company entities who may be required to follow in Ind AS as per relevant regulatory requirement applicable to such entities' recurrence. Annexure 1. Criteria for classification of non-corporate entities are decided by the Institute of Chartered Accountants of India. Level 1 entities. Non-company entities which fall in any one or more of the following categories at the end of the relevant accounting period are classified as level 1 entities. Entities whose securities are listed or are in process of listing on any stock exchange, whether in India or outside India. Bank, including corporate bank, financial institution or entities carrying on insurance business. All entities engaged in commercial, industrial or business activities whose turnover excluding other income exceeding rupees 20 to 50 crore in the immediately preceding accounting year. All entities and commercial, industrial or business activities having the borrowing including public deposits in excess of rupees 50 crore at any time during the immediate preceding accounting year, holding and subsidiary entities of any of the following, any of the above. Level 2 entities, non company entities which are not level 1 entities but fall in any one of the following categories are classified as level 2 entities. All entities engaged in commercial, industrial or business activities whose turnover excluding other income exceed rupees 50 crore but does not exceed rupees 250 crore in the immediate preceding accounting year. All entities in engaged in commercial, industrial or business activities having borrowing including public deposits exceed rupees 10 crore but does not exceed rupees 50 crore at any time during the immediately preceding accounting year, holding as subsidiary entities of any of the above. Level 3 entities, non company entities which are not covered under level 1 and 2, level 2 but fall in any or more of the following categories are classified as level 3 entities. All entities engaged in commercial, industrial or business activities whose turnover exceeding other income exceeds rupees 10 crore but does not exceed rupees 50 crore in immediately preceding accounting year. All entities engaged in commercial, industrial or business activities having borrowing including public borrowing in excess of rupees 2 crore but does not exceed rupees 10 crore at any time during the immediately preceding accounting year. Level 4 entities, non company entities which are not covered under level 1 to level 2 and level 3 are considered as level 4 entities. Additional requirements: an MSME which avail the exemption or relaxation given to its shall disclose by way of a note to its financial statements the fact that it is an MSME, the level of MSME, and that it has complied with accounting standard insofar as they are applicable to entities falling in level 2 and level 3 or level 4 as the case may be, where the where an entity being covered in level 2, level 3, level 4 has had qualified for any exemption or relaxation previously but no longer qualified for the relevant exemption or relaxation in current accounting period. The relevant standard or requirement before applicable from the current period. The figures for corresponding period of the previous accounting period need not be revised merely by reason of its having ceased to be covered in level 2 or level 3 or level 4 as the case may be. The fact that the entity was covered in level 2 or level 3 or level 4 as the case may be in the previous period, and it had availed of exemption or relaxations available to that level of entities has shall be disclosed in the note to the financial statements. The fact that previous period figures have not been revised shall also disclosed in notes to the financial statements. Where an entity has been covered in level 1 and subsequently ceases to be so, where an entity has been level 1 and subsequently ceases to be so covered and get covered in level 2, 3 or 4, the entity will not qualify for exemption relaxation available to that level until the entity ceases to be covered in level 1 for 2 consecutive years. Similarly, in the case of respective entity which has been covered in level 2 or level 3 and subsequently get covered under level 3rd or 4th. If an entity covered level 2, level 3, level 4 opt not to avail of the exemption or relaxation available to the level of the entities in respect of any but not all accounting standard, it shall disclose the standard in respect of which it has availed the exemption or relaxation. If the entity covered in level 2, level 3 or level 4 opt not to avail any or more of the exemption or relaxation available to that level of entity, it has shall comply with the relevant requirement of the accounting standard. The entity covered in level 2 or level 3 or level 4 may opt for availing certain exemption or relaxation from compliance with requirement prescribed in accounting standards, provided that such a partial exemption or relaxation and disclosure shall not be permitted to mislead any person or public. In respect of accounting standard 15, employee benefit exemption relaxation are available to level 2 and level 3 entities under two subsequent classification: entities whose average number of person employed during the year is 50 or more, entities whose average number of person employed during the year is less than 50. The requirement is stated in paragraph 1 to 6 above mutatis mutandis apply to these subclassifications. Applicability of accounting standard to non-company entities. Accounting standard issued by ICAI on April 1st, 2020, and such standards are issued from time to time are applicable to non-company entities subject to relaxation and exemption in the announcement. The accounting standards issued by ICAI as on April 1st, 2020 are AS1 disclosure of accounting policies, AS2 valuation of inventories, AS3 cash flow statements, AS4 contingencies and event occurring after balance sheet date, AS5 net profit or loss for the period prior period items and changes in accounting policies, AS7 construction contracts, AS9 revenue recognition, AS10 property plant equipments, AS11 the effect of changes in foreign exchange rates, AS12 Accounting for Government Grants. AS13 Accounting for Investments. AS14 Accounting for Amalgamations. AS15 Employees Benefits. AS16 Borrowing Cost. AS17 Segment Reporting. AS18 Related Party Disclosure. AS19 Leases. AS20 Earning per Share. AS21 Consolidated Financial Statements. AS22 Accounting for Taxation on Income. AS23 Accounting for Investment in Associate in Consolidated Financial Statement. AS24 Discounting Operations. AS25 Interim Financial Reporting. AS26 Intangible Assets. AS27 Financial Reporting of Interest in Joint Ventures. AS28 Impairment of Assets. AS29 Provision for Contingent Liabilities and Contingent Assets. Applicability of Accounting Standard to Level 1 Non-Company Entities. Level 1 entities are required to comply in full with all the accounting standards. Applicability of accounting standard and exemption relaxations for Level 2, Level 3 and Level 4 non-company entities. Accounting standard. Level Accounting Standard 1 applicable for Level 2 entities, applicable for Level 3 entities, applicable for Level 4 entities. Accounting Standard 2 applicable for Level 2 entities, applicable for Level 3 entities, applicable for Level 4 entities. AS3 not applicable for Level 2 entities, not applicable for Level 3 entities, not applicable for Level 4 entities. AS4 applicable for Level 2, Level 3, Level 4 entities. AS5 applicable to Level 2 entities, Level 3 entities, Level 4 entities. AS7 applicable to Level 2 entities, Level 3 entities, Level 4 entities. AS9 applicable to Level 2 entities, Level 3 entities, Level 4 entities. AS10 applicable to Level 2 entities, applicable with disclosure exemptions, applicable with disclosure exemption. Applicable with disclosure exemption is in both Level 2, Level 3 and Level 4 entities for AS10. AS11 applicable for Level 2 entities, applicable with disclosure exemptions for Level 3 entities, applicable with disclosure exemption with for Level 4 entities. AS12 applicable for Level 2 entities, Level 3 entities, Level 4 entities. AS13 applicable for Level 2 entities, applicable for Level 3 entities, applicable with disclosure exemption for Level 4 entities. AS14 applicable for Level 2 entities, applicable for Level 3 entities, not applicable for Level 4 entities. Refer to Note 2C. रेफर नोट्स 2C आगे देखेंगे. AS15 है applicable with exemptions for Level 2 entities, applicable with exemption for Level 3 entities, applicable with exemption for Level 4 entities. AS16 applicable for all three levels, applicable for all three levels, Level 2, 3 and 4. AS17 not applicable for all three levels, Level 2, level 3, level 4. AS18 applicable for level 2 entities but not applicable for level 3 and level 4. AS19 applicable with disclosure exemptions for all 3 entities, level 2, level 4, 3, level 4. AS20 not applicable for all 3 entities, level 2, level 3, level 4. AS21 not applicable, refer to note 2D for 3 entities, level 2, level 3, level 4. नोट 2D बाद में देखेंगे. AS22 applicable for level 2 and level 3 entities but for level 4 applicable only for current tax related provisions. Refer to note 2B6 बाद में देखेंगे. AS23 not applicable, refer note 2D. Not applicable, refer note 2D in both in all 3 entities, level 2, level 3, level 4 entities. AS24 applicable only to level 2 entities, level 3 not applicable, level 4 not applicable. AS25 accounting standard 25 not applicable, refer to note 2D for all 3 entities, level 2, level 3, level 4. AS26 applicable for both level 2, level 3 entities. For level 4 applicable with disclosure exemption. AS27 not applicable. Not applicable, refer to note 2C and 2D for all 3 entities, level 2, level 3, level 4. AS28 applicable with disclosure exemptions for all 3 entities, level 2, only for 2, that is for level 2 and level 3. For level 4 AS28 is not applicable. AS29 applicable with disclosure exemption for 3 entities, level 2, level 3 and level 4. B. Accounting standard in respect of which relaxation exemption for certain requirement has been given to level 2, level 3 and level 4 non-companies entities. Accounting standard 10 property plant equipment, paragraph 87 relating to encourage the disclosure is not applicable to level 3 and level 4 non-company entities. AS11 the effect of changes in foreign exchange rate revised 2018, paragraph 44 relating to encourage disclosure is not applicable to level 3 and level 4 non-companies entities. AS13 accounting for investments, paragraph 35F relating to disclosure is not applicable for level 4 non-company entities. Accounting standard 15 employees benefit revised 2005, level 2 and level 3 non-company entities whose average number of persons employed during the year is 50 or more are exempted from the applicability of following paragraph. Paragraph 11 to 16 of the standard to the extent they deal with recognition and measurement of short-term accumulating compensated absence which are not non-vesting. that is short-term accumulating compensated absence in report of which employee are not entitled to cash payment for unused entitled on leaving. B. Paragraph 46 and 139 of the standard which deals with discounting of amount that fall due more than 12 months after the balance sheet date. Recognition and measurement principle laid down in paragraph 45 to 116 and presentation and disclosure requirement laid down in paragraph 117 to 123 of the standard in respect of accounting for defined benefit plans. However, such entities should accurately actually det- determine and provide for accrued liability in respect of defined benefit plan by using the projected unit credit method, and the discount rate used should be determined by reference to market yield at the balance sheet date on government bond as per paragraph 78 of the standard. Such entities should disclose actuarial assumption as per paragraph 121st of the standard. Recognition and measurement principles laid down in paragraphs 129 to 131 of standard in respect of accounting for other long-term employee benefits. However, such entities should actually determine and provide for the accrued liability in respect of other long-term employee benefit by using the projected unit credit method, and the discount rate used should be determined by reference to market yield at the balance sheet date on government bond as per paragraph 78 of the standard. Level 2 and level 3 non-company entities whose average number of person employed during the year is less than 50, and level 4 non-company entities irrespective of number of employees are exempted from applicability of the following paragraphs. Paragraph 11 to 16 of standard to the extent they deal with recognition and measurement of short-term accumulating compensated absence which are non-vesting, that is short-term accumulating compensated absence in respect of which employees are not entitled to cash payment for unused entitlement on leaving. Paragraph 46 and 139 of standard which deals with discounting of amount that fall due more than 12 months after the balance sheet date. Recognition and measurement principle laid down in paragraph 52-116 and presentation and disclosure requirement laid down in paragraph 117 to 123 of the standard in respect of accounting for defined benefit plans. However, such entities may calculate and account for the accrued liability under the defined benefit plan by reference to the some other rational method. Example, a method based on assumption that such benefits are payable to all employees at the end of the accounting period. Recognition and measurement principle laid down in the paragraph 129 to 131 of the standard in respect of accounting of other long-term employees benefits. Such entities may calculate and account for accrued liabilities under the other long-term employee benefit by reference to some other rational method. Example method based on the assumption that such benefits are payable to all employees at the end of accounting period. AS 19 Leases. Paragraph 22C 22 subsection C subsection E and F 25 subsection A 25 clause A clause B and clause E 37 clause A and F and 46 clause B and D relating to disclosure are not applicable to level 2 non-corporate entities. Paragraph 22 clause C, E and F 25 section 25 clause A clause B and clause E 37 clause A F and G and 46 B clause D clause E relating to disclosure are not applicable to level 3 non-company entities. Paragraph 22 C, E and F 25 A, B and E 37 A, F and G 38 and 46 B, D and E relating to disclosure are not applicable to level 4 non-company entities. AS 22 Accounting for taxes on income. Level 4 non-company entities shall apply the requirement of AS 22 accounting for taxes on income for current tax defined in paragraph 44 of AS 22 with recognition as per paragraph 9, measurement as per paragraph 20 of AS 22 and presentation and disclosure as per paragraph 27 and 28 of AS 22. Transitional requirements. On the first occasion when non-company entities get classified as level 4 entities, the accumulated deferred tax assets liabilities appear in financial statement of immediate previous accounting period shall be adjusted against the opening revenue reserves. AS 26 Intangible assets. Paragraphs 90D 3rd, 90D 4th and 98 relating to disclosure are not applicable to level 4 non-company entities. AS 28 Impairment of assets. Level 2 and level 3 non-company entities are allowed to measure the value in use on the basis of reliable estimate thereof instead of computing the value in use by present value technique. Consequently, if level 2 and level 3 non-company entity chooses to measure the value in use by not using the present value technique, the valuation provision of AS 28 such as discount rate etc. would not be applicable to such an entity. Further, such an entity need not disclose the information required by paragraph 121 G of the standard Also, paragraph 121C, second, 121D, first, 121D, second, and 123 relating to disclosure are not applicable to level 3 non-company entities. AS29 provisions, contingent liabilities and contingent assets revised 2016. Paragraph 66 and 67 relating to disclosure are not applicable to level 2nd, level 3rd and level 4 non-company entities. In case of level 4th non-company entities, generally there are no such transactions that are covered in under AS 14. Accounting for amalgamation or joint control operation are jointly controlled assets covered under AS 27. Financial reporting of interest in joint venture, therefore these standards are not applicable to level 4 non-company entities. However, if there are any such transaction, these entities shall apply the requirement of the relevant standard. AS21 consolidated financial statement. AS23 accounting for investments in association of in consolidated financial statement. AS27 financial reporting of interest in joint venture to the extent of requirement relating to consolidated financial statement, and AS25 interim financial reporting do not require non-company entities to present consolidated financial statement and interim financial reporting respectively. Relevant AS is applicable only if non-company entities is required or elects to prepare and present consolidated financial statement or interim financial report. Example 1. Messrs. Omega and Company, a partnership firm, has turnover 1.25 crore excluding other income and borrowing of 0.95 crore in the previous year. It wants to avail the exemption available in the application of accounting standard to non-corporate entities for the year 31st March 2021. Advise the management of Messrs. Omega and Company in respect of exemption of provisions of AS as per the directive issued by the ICAI. The question deals with the issue of applicability of accounting standard for to non-corporate entities for availment of exemption. First of all, it has been seen that Mr. Omega falls which level of non-corporate entities it classifies will be done on the basis of classification of non-corporate entities as per prescribed by the ICAI. According to the ICAI, non-corporate entities has classified under 4 levels: level 1, level 2, level 3 and 4 entities. Non-corporate entities which meets following criteria are classified as level 4 entities. All entities engaged in commercial, industrial or business activities whose turnover excluding other income does not exceed 10 crore in immediately preceding year. All entities engaged in commercial, industrial business having the borrowing capital does not exceed rupees 2 crore at any time during the immediately preceding accounting year, holding and subsidiary of any of the above. As per turnover, Messrs. Mega is less than 10 crore and borrowing as the turnover of Messrs. Omega and Company is less than 10 crore and borrowing less than 2 crore. It falls in level 4 non-corporate entities. In this case, AS3, AS14, AS17, 18, AS20, 21, 23, AS24, 25, 27 and 28 will not be applicable to Mrs. Omega and Company. Relaxation from certain requirement in respect of years 10, 11, 13, 15, 19, 22, years 26 and years 29 are also available to Mrs. Omega and Company. Criteria for classification of companies under Companies Accounting Standard Rule 2021. If small and medium sized companies are defined in clause 2E of the Companies Accounting Standard Rule 2021, small and medium sized company SMC means a company whose equity or debt security are not listed or are not in process of listing on any stock exchange, whether in India or outside India, which is not a bank, financial institution, or a insurance company, whose turnover excluding other income does not exceed rupees 250 crore in immediately preceding accounting year, which does not have borrowing including public deposit in excess of rupees 50 crore at any time during immediately preceding accounting year, and which is not holding or subsidiary of the company, which is not a small and medium sized company. Explanation: for the purpose of clause 2E, a company should qualify a small and medium sized company if the condition mentioned therein are satisfied at the end of the relevant accounting period. Non-SMCs. Companies not falling within the definition of SMCs are considered as non-SMCs. Instruction. General instruction. SMCs should follow the following instruction while complying with the accounting standard under these rules. SMC which does not disclose certain information pursuant to the exemption and relaxation it given to it should disclose by way of note to its financial statements the fact that it is an SMC and has complied with the accounting standard is insofar as they are applicable to SMC on the following lines. The company is a small and medium sized company. SMC are defined in the Companies Standard Rule 2021 notified under the Companies Act 2013. Accordingly, the company has complied with accounting standard as applicable to small and medium sized company, where the company being an SMC has qualified for any exemptions or relaxation previously but no longer qualifies for relevant exemption or relaxation in current accounting period, the relevant standard or requirement become applicable from the current period, and figures for corresponding periods of the accounting period need not be revised merely by reason of its having ceased to SMC. The fact that the company was an SMC in previous period and it has availed of the exemption and relaxation available to SMCs should be disclosed in the note to the financial statements. If the SMC opt not to avail the exemption and relaxation available to an SMC in respect of any but not all of the accounting standard, it should SMC in respect of any but not all of the accounting standard, it should disclose the standard in respect of which it has availed the exemption or relaxation. If an SMC desired to disclose the information not required to be disclosed pursuant to exemption or relaxation available to the SMC, it should disclose that information in compliance with relevant accounting standard. The SMC may opt for availing certain exemption or relaxation from compensation with requirement prescribed in accounting standard, provided that such a partial exemption or relaxation and disclosure should not be permitted to mislead any person or public. Note: an existing company which was previously not SMC and subsequently become a SMC shall not be qualified for exemption or relaxation in respect of accounting standard available to SMC until the company remain a SMC for two consecutive accounting period. Applicability of accounting standard to the companies other than the following: Indian accounting standard Ind AS 1 2.3.1. Accounting standard applicable in their entirely to the companies. AS1 disclosure of accounting policy. AS2 valuation of inventories revised 2016. AS3 cash flow statements. AS4 contingencies and event occurring after balance sheet date revised. AS6 revised 2016. For applicability of Ind AS to the companies, refer notification dated 16th February 2015 issued by Ministry of Corporate Affairs of India. AS5 net profit and loss for the prior period items and changes in accounting policies. Construction contract revised 2002. AS9 revenue recognition. AS10 property plant equipment. AS11 effect of changes in foreign exchange rates revised 2003. AS12 accounting for government grants. AS13 accounting for investments revised 2016. AS14 accounting for amalgamation revised 2016. AS16 borrowing cost. AS18 related party disclosure. AS21 consolidated financial statements revised 2016. AS22 accounting for taxes and income. AS23 accounting for investment in associate in consolidated financial statements. AS24 discounting operations. AS26 intangible assets. AS27 financial reporting of interest in joint ventures. Exemptions or relaxation for small and medium sized companies SMCs as defined in notification dated June 23, 2021 issued by the Ministry of Corporate Affairs, Government of India. First, accounting standard not applicable to SMCs in their entirely. AS17 segment reporting. Second, accounting standard in respect of which relaxation from certain requirement has been given to SMCs. First, accounting standard AS15 employees benefit revised 2005. Paragraph 11 to 16 of standard to the extent they deal with recognition and measurement of short-term accumulated compensated absences which are not vesting, that is short-term accumulating compensated absence in respect of which employees are not entitled to cash payment for unused entitlement on leaving. Paragraph 46 and 139 of standard which deals with discounting of amount that fall due more than 12 months after the balance sheet date. Recognition and measurement principle laid down in paragraphs 50 to 116 and presentation and disclosure requirement laid down in paragraph 117 to 123 of standard in respect of accounting for defined benefit plans. However, such companies should actually determine and provide for accrued liability in respect of defined benefit plan by using the projected unit credit method, and discount rate used should be determined by reference to market yield at balance sheet date on government bonds as paragraph 78 of the standard. Such companies should disclose the actual exemptions as per paragraph 120 first of the standard and recognition and measurement principle laid down in paragraphs 129 to 131 of standard in respect of accounting for the other long-term employees benefit. However, such companies should actually determine and provide the accrued liability in respect of other long-term employee benefit by using the projected unit credit method, and discount rate used should be determined by reference to market yield at the balance sheet date on government bonds as per paragraph 78 of the standard. AS 19 leases paragraph 22 C, E and F, 25 A, B and E, 37 A and F and 46 B and D relating to disclosure are not applicable to SMCs. AS 20 earning per share, disclosure of diluted earning per share both including and excluding extraordinary items is exempted for SMCs. AS 28 impairment of assets. SMCs are allowed to measure the value in use on the basis of reasonable estimated thereof instead of computing the value in use by present value technique. Consequently, if the SMC choose to measure the value in use by not using the present value technique, the relevant provision of AS 28 such as discount rate etc. would not be applicable to such SMCs. Further, such an SMCs need not be disclosed the information required by the paragraph 121G of the standards. AS 29 provisions contingent liabilities, contingent assets revised. Paragraph 66 and 67 relating to disclosure are not applicable to SMCs. AS 25 interim financial reporting does not require a company to present interim financial reporting. It is applicable only if the company is required or elect to prepare and present an interim financial report. Only certain non-SMCs are required by the concerned regulators to present interim financial results. Example, quarterly financial result required by the SEBI. Therefore, the recognition and measurement requirements certain by the accounting standard are applicable to those non-SMCs for preparation of interim financial results. Summary. According to the criteria for classification of entities and applicability of accounting standard are issued by government, there are two levels, namely small and medium sized company. SMCs are defined in companies accounting standard rules, and companies other than SMCs, non-SMCs, are required to comply with all accounting standards in their entirety, while certain exemption relaxation have been given to SMCs. Criteria for classification of entities for applicability of accounting standard for corporate and non-corporate entities have been prescribed as per government notification. Multiple choice questions. Non-corporate entities which are not level first entities whose turnover excluding other income exceeds dash but does not exceed rupees 250 crore in the immediate preceding accounting year are classified as level second entities. First 5 crore, second 2 crore, third 50 crore, fourth 10 crore. The answer is 50 crore. Following accounting standard is not applicable to non-corporate entities falling in level second entities in its entirety. AS10, AS17, AS2, AS13, AS17 is not applicable. All non-corporate entities engaged in commercial, industrial and business reporting entities whose turnover excluding other income exceed rupees 250 crore in immediately preceding accounting year are classified as level 2 entities, level 1 entities, level 3 entities, level 4 entities. The answer is level 1 entities. All non-corporate entities engaged in commercial, industrial and business activities having the borrowings including deposits exceed rupees 2 crore but does not exceed rupees 10 crore at any time during the immediately preceding accounting year. Level 2 entities, level 4 entities, level 3 entities, level 1 entities. The answer is level 3 entities. Small and medium sized companies SMCs means which may be bank, financial institution or an insurance company whose turnover excluding other income does not exceed rupees 250 crore in immediately preceding accounting year, whose turnover excluding other income does not exceed rupees 50 crore in immediately preceding accounting year, whose turnover excluding other income does not exceed 500 crore in immediately preceding accounting year. The answer is a small and medium sized company means a company whose turnover excluding other income does not exceed 250 crore in the immediately preceding accounting year. What are theoretical questions? What are the issues in which accounting standard deals? Accounting standard deal with the issue first recognition of events and transaction in the financial statement, measurement of these transaction and events, presentation of these transaction and events in the financial statement in the manner that is meaningful and understandable to the reader. Fourth, disclosure requirements. List the criteria to be applied for rating a non-corporate entities as level first entities and level second entities for the purpose of compliance of accounting standard in India.